Hi, I'm Alex. Welcome to the channel and thanks for tuning in. In today's video, we're going to be talking about Rimini Street, ticker RMNI. This is a tech stock which is massively undervalued versus its peers, has great recurring revenues, is cash generative, and has really exciting growth prospects. It also has an exciting counter-cyclical proposition, and spoiler alert, I am invested in this stock. It releases its earnings this week, and so this might be one which you want to take a look at. As part of this video, we'll be covering absolutely everything which we as investors need to know about the company, both the positives and the negatives. Now, this is something which I shared with the Patreon members and those which were on the private Discord group last week. Since then, it's up about 10%, however I still believe there's a massive upside potential from here. If you're interested in that Patreon or the Discord group, then check the link in the description below. If you're new to the channel and you like investing related content, then hit that subscribe button. The YouTube algorithm doesn't like my unpredictable upload schedule, and as a result, oftentimes my videos don't get pushed to people who are subscribed. If you want to make sure you don't miss a video, hit that bell button next to the subscribe button, and that should make sure you get notified when I do upload. If you like the video, please hit the like button. It's so helpful in pushing the channel to a wider audience. And as always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So, what does it do? Rimini Street provides third-party software maintenance services for primarily ERP systems. In essence, what they're providing their customers is maintenance and support services for people who are using SAP and Oracle and other systems as their ERP. Partly their proposition is focused around cost saving. It's cheaper than using SAP or Oracle for the maintenance, especially as both SAP and Oracle are trying to drive all of their customers onto the latest instance of the software and be on the cloud. So Rimini Street's customers are both those who want to save money, who don't want to be paying around what can be 20% of the original license fee annually to SAP and Oracle for ongoing maintenance and support, or alternatively it's customers who don't want to upgrade to the latest instance of the software, don't want to be on the SaaS model, and ultimately where SAP and Oracle are starting to cut the service to them. Now it's worth noting here that Rimini Street can only offer its services to customers who are not using the cloud-based software. So ultimately, if it's not on the cloud and it's a license-based software and the customer owns it, then Rimini Street can provide its services. It has been a big focus of a lot of the ERP players to drive their customers onto the cloud. Not only is the SaaS model a lot more attractive to them from a financial perspective, it also enables them to cut out this dynamic of third-party maintenance providers. However, moving to the cloud is not appropriate for all companies. That whole cloud transition project can be costly, very time consuming, and ultimately a lot of its customers are using very bespoke instances of the software. A lot of development and a lot of personalization has gone into the software that they're running, and that would have to be all done again if they were to shift to the cloud proposition. So really, this is not appropriate for all companies. So Rimini Street, as well as making sure that customers aren't left behind by the lack of support on certain instances of software, also helps ensure that the software is kept up to date. It installs security patches, fixes bugs, it creates additional flexibility, develops new modules, and ultimately just keeps the software going. So, what are the positives? Well, the first positive I see is that there's a very clear customer proposition. Ultimately, it's getting something better for less. Ultimately, IT budgets are continually under pressure. Maintenance costs form a big part of the IT expenditure too, and so ultimately being able to cut those costs whilst ensuring that the same service is provided, and ultimately eliminating the risk from the customer's perspective that perhaps their ERP provider may withdraw support, is a strong value proposition. Now, as we touched on before, cloud transition for a number of these companies is not appropriate. The current installations of their ERP systems are oftentimes very bespoke and have undergone a lot of development, and that's been a lot of investment gone into that. For the old licensed model, this puts a number of those users in challenging positions. However, this is where Rimini Street's proposition comes in. As this support is being withdrawn, many customers are moving to Rimini Street and are seeking to stay on their existing licensed software proposition for a while longer. Given that the original software vendors are withdrawing their support for the product, its customers have to find an alternative, and that's exactly where Rimini Street is playing. In short, Rimini Street adds value to its customers because it enables them to get more from their existing systems and saves costs versus the alternatives. Now, the second attractive dynamic about this investment I see is the big and growing market. Now, the market growth is being accelerated by the announcement that SAP and Oracle are withdrawing this support and are trying to force customers onto the cloud model. This in itself will affect a massive number of the current customers of those ERP software players. A recent Gartner report suggested that the overall market could grow by over 300% by 2023. Currently, Rimini Street is the market leader, and it's very well positioned to capitalise on that massive market growth opportunity. What we have here is a very tangible growth plan. It's very easy to see why this is happening and the dynamics at play, and personally, that's something I really like to see. Now the next positive I see is around the mission critical demand. For companies, their ERP system operating effectively and being supported and maintained is absolutely mission critical. Having a working ERP is not a nice to have, it has to be working. Also, regardless of the situation, this has to be supported and maintained, whether that is from the original software vendor or from a third-party provider. Customers are not going to go without their support and maintenance for their ERP. Doing so would expose them to a massive number of risks, many of which could potentially come with massive financial penalties. For example, data breaches. What's more, customers are also very sticky here. You don't want to be chopping and changing your provider all the time. Once you have a supplier who does a good job for you, maintains your systems suitably, you stick with them because it is so important. Again, that is the dynamic I really like to see. Now at this point I'm sure a number of people are thinking, oh well, it's just the low value budget customers who are going for this option. No, that's not the case at all. There are a number of really high profile blue chip customers who are using Rimini Street currently. As I touched on before, the transition to the cloud-based software is not suitable for all customers. These customers may have a licensed version of the software that's very old, but actually in itself has had a lot of investment put into it, developing new modules, add-ons, different parts to it, which because of the complexity of the business using it, does need to be highly bespoke. That means an off-the-shelf cloud-based version of the software isn't going to be appropriate, and ultimately the company at that point in time isn't going to want to incur the same investment it has done historically to make it as flexible and usable. For example, a couple of Rimini Street's current customers are the Ministry of Justice, the Bank of China, and British Telecoms. All of those blue chip established names, not bottom fisher customers at all. The next positive and thing I really like about this business is the fact it has really strong recurring revenues and it has very high net retention rates. Now this provides good resilience to the business and also is a good validator of the customer proposition. For the last fiscal year, almost 100% of the revenues generated were recurring and the net retention rate was 92%. Again, this is a resilient business with a strong customer proposition. The next thing I like about Rimini Street is the tangibility of its growth plan. Ultimately, as Oracle and SAP and other ERP software providers do cut off their support for their legacy licensed software business, that will increase demand and the necessity for Rimini Street services and will force many customers to them. Rimini Street itself is also restructuring its sales side of the business. This is being done to make the sales function more effective, to drive greater upsell, and ultimately the sales staff will be incentivized more appropriately. Now, given where we are in the current economic cycle, one important thing to think about is how counter-cyclical the businesses we are investing into may be. Now with Rimini Street, there is perhaps a counter-cyclical angle to this investment. During economic downturns, big technology investments are likely to be delayed and deferred. Any slowdown in this trend driven by the health of the economy is positive for Rimini Street. More customers will come to Rimini Street for their services rather than investing in and upgrading to the newest software. The next thing I like about Rimini Street is how I believe it's definitely set up well to beat analyst estimates this year. It's set to announce its Q4 and full year results on March 3rd, and historically, Q4 for the business has always been its most successful and the one where it generates the most revenue in. Rimini Street also has an impressive track record of performing well. In fact, for the last 15 quarters of financial results, it has delivered year-on-year growth. That's pretty impressive. What's more, we know that in order to hit the analyst estimates for the year, it needs to deliver 7% growth on the previous years. To put that into context, in the Q4 filings for the last 2 years, they delivered 14% growth on the year before, and in 2017, they delivered 28% growth on the year before. All in all, if Rimini Street has sustained its growth levels, it should be beating analyst estimates, and that's great news. Now the next real positive I see here is how Rimini Street is massively undervalued versus its peers. Now, whilst it is difficult to find a direct competitor, a good read across is actually the enterprise software players. A business which is delivering over 20% growth annually, underpinned by almost 100% recurring revenues, and mission critical demand shouldn't be trading at just 1.5 to 2 times its forward sales. SAP is trading at around 5 times and Oracle at around 5.5 times its forward sales. So clearly here, it is undervalued versus its peers. Now obviously, these are just benchmarks. However, I do believe the company is undervalued versus its peers. Now, there may be a reason for this, potentially the ongoing litigation, which we'll touch on shortly, but all of that aside, this business clearly is undervalued. Another positive and something that's good to triangulate our understanding with is the analyst views. Now, all the analysts which cover the stock are bullish on it. All 5 analysts which cover the stock currently have buy ratings on it, and the average of their current price targets is between $10 and $11, with one even at the $15 level. This is something I always like to see, and it's good to have our views validated in that way. So, what are the negatives? Well, the first real negative, and one of the main things here, is the ongoing litigation with Oracle. Now, this really could be a biggie. Providing support for Oracle products accounts for around 65% of the revenues generated by Rimini Street. So at this point in time, Rimini Street currently is undergoing some litigation, as in the process of litigation with Oracle. Now, this originally dates back to around 2010. Ultimately, it's all focused around how Oracle and other ERP providers are doing this as well, are unhappy that third-party providers are coming into the market, are acting competitively, and are winning customers from them. This service and maintenance line for the original software vendor is a very profitable business line. So ultimately, this is the core reason as to why this litigation is ongoing. Now in 2015, Rimini Street did make a settlement payment to Oracle in the region of around $124 million. However, despite this, a series of different lawsuits continues. Now, based on our current understanding, there shouldn't be a hearing in relation to this until around mid-2022. However, anything could happen here. Now, Oracle and SAP and many of the other ERP providers do have a track record of this litigation. The outcome of a lot of these have been these companies paying damages to Oracle and the other providers. Now, this clearly is a serious risk. Both SAP and Oracle and all the other providers are threatened by the fact that Rimini Street are coming in and are providing a service for a lower cost and damaging Oracle and SAP's margins. Now, with many risks, there's often a mitigant. However, here, there isn't really one at all. Now, obviously, the hearing is some time off, and once a decision is made, that still could be subject to delays. However, you can't escape the fact that this is happening. Ultimately, what it will come down to is a jury deciding, has there been malpractice here? Now, ultimately, this is something that Oracle will fight. All you need to do is look at their website and see the page they have dedicated to Rimini Street. Now, I do need to say at this point that this does have a number of false statements on it. However, it is clear to see there's no love lost between these two companies. There's no escaping the fact that if the jury was to vote in favour of Oracle here, that could be massively detrimental for the business. Not only could there be big fines, it could also mean that Rimini Street can no longer provide services for Oracle products, which, as we mentioned before, account for around 65% of its revenues. So yes, this is a big one, and it's one we need to get comfortable with. Clearly, this is part of the reason for the discount in valuation. However, I don't think it justifies the magnitude of that discount versus its peers. Now, the next risk here that you can't escape is the fact that potentially the whole total addressable market could be eradicated by every customer shifting from the licensed software to the cloud-based one. Ultimately, when the customers are using the cloud-based version of the software, they don't own the license, so they can't use a third-party provider. In those situations, they're stuck with using whoever provides their ERP. Now, against this risk, I do feel there are some mitigants. Ultimately, we know the cloud proposition isn't suitable for all customers. We know that the whole upgrading process is very costly, it's time-consuming, and for many customers it won't deliver the ROI which they require. This is especially important in tighter economic times when budgets are being squeezed even more. Additionally, we touched on it earlier, but there is the counter-cyclical dynamic here, that during an economic slowdown, or a slowdown triggered by the impact of the health crisis we've been through, that could slow down spending and could ultimately slow the shift of customers from the legacy licensed product to the SaaS product. Additionally, the cloud software overall is more expensive. For some customers, that overall increase in cost may just be too prohibitive. Now, another potential risk with the company that we need to be aware of is the fact that there is a very slow sales cycle here. Ultimately, the sales team need to really be bang on it. A slow quarter here can really impact the entire year. The sales team need to be consistently delivering both new products, upsells, and new customers. This is absolutely essential. Ultimately, the risk here is that the business's sales division fails. I do believe perhaps this is mitigated because it has been a strong area of focus for management. They have restructured the sales teams, they've realigned the incentives, and clearly it is something they're very aware of and are focusing on, so that's good. Now, the final risk I want to touch on is more broadly around a market risk, and it's the rotation from tech stocks to value stocks. Now, I do have a video series coming where I will address this in much more specific detail. However, ultimately, as government bond yields increase, driven by the fear of inflation, where businesses which are higher growth and where the majority of the value comes in later years, see a larger negative impact to their overall valuation versus companies which are lower growth and where the balance of their cash flows over a forecast period is delivered evenly. Now, given that Rimini Street does have good growth prospects and it is in the tech sector, there's a risk that it could be hit by this. Ultimately, while this could be a risk we see, I think this is somewhat mitigated by the fact that the delta in the valuation versus its peers will not be closed by this movement. I do expect all of the main ERP and the service provider players to all move in a similar dynamic. Ultimately, what that means is that the discount versus its peers should remain pretty similar. Again, part of this thesis is that Rimini Street is undervalued versus its peers. So as long as that is maintained, even if valuations do fall across all the sector, that thesis still stands. So finally, what am I doing? Well, I have taken a position in this stock, and I have built my position over a number of days in advance of the earnings release. When we get the news of that on March 3rd, I will then reassess the position, see how they've performed and see what impact that has on the stock price. Ultimately, I typically look to build my position over a period of a couple of weeks until I'm happy with the level of exposure I have to that opportunity. For me, again, this is a long-term thesis-led investment. I'm investing in the company to see how they deliver on their growth plan, and I ultimately want to see how the legal proceedings pan out and play out as well. Ultimately, in the coming years, I hope to get more clarity on the legal position and see them deliver on the growth and maintain and establish an even greater market leadership. Over the coming years, I also expect them to win more blue chip customers for their support services as well. And ultimately, that's always good to see in the companies we're invested in. But anyway, thank you so much for watching. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel and you like investing related content, then hit that subscribe button. If you like this kind of content and you want to see more, check out the Patreon. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting hearing everyone's opinions and perspectives, so please get involved. Thank you so much for watching, and I'll see you in another video.